Top three things in my notebook this morning are Europe, the oil price, and the 10-year bond yield. So first, if you dig into Europe, the economic data is just flat out awful. This morning, actually, up on the website, we have a title that says ugly charts. Now, if you can see in rate of change terms, which is what we care about most, they're just flat out ugly. Now, most people would say, well, you know, they're only down 1%, or it's down this, or it's down that. And it's like rate of change, get it right. If you get rate of change right, you get bond yields right, because rate of change, when it starts to decline, bond yields fall in kind. So again, this is why interest rates went up last year. U.S. growth is accelerating, and that's why it's falling this year. That's why German bond yields are falling this year, because growth is falling in rate of change terms. So again, look at Europe across the board as the FTSE and the DAX, after a one-day bounce, fail miserably at, I wouldn't even say they challenged any line of resistance. The FTSE, the DAX, the MIB index remain decisively bearish trends at Hedgeye, and one of our Q4 macro themes is indeed called Europe slowing. Second point, oil. Now again, this is DEF Quad 4. DEF Quad 4. We are in the DEF Quad 4. Another institutional investor calls me the other day. He goes, Keith, what the hell is the Quad 4? I mean, well, if you want to look at it, look at a chart of oil. You will see indeed that we are in the fourth quadrant, which occurs when you have both demand growth and inflation slowing at the same time. Now you can see this. A lot of people obviously are offsides in oil, but again, today is not the day that you short oil. The immediate term trade oversold signal in oil on WTI is 80.07. God called me with the number. Indeed, that is the number. Kidding, obviously, but this is where we're oversold. So again, we'll see some capitulation. Then we'll see what happens on the bounce. But again, oil remains bearish trend in as much as the CRB index does. And by the way, the Fed agrees with that. Now, that's the final point. The finishing move on the 10-year bond yield as we go towards 2% is, of course, that the Fed comes in line with our view and gets more dovish on the margin. So the Hilsenrath comes out this morning and says, hey, look, the Federal Reserve is looking at the CRB index. Guess what? The Federal Reserve only looks at the CRB index when it's going down. Because, of course, when it was up 12% year to date, the Fed didn't need to raise rates. So, again, they go one way. You know that. When the market and the economy and or both go down, the Fed gets easier. So the 10-year bond yield goes lower. And we would reiterate that view. So, again, you will get oversold on the 10-year bond yield. Today's not the day to buy TLT. You buy it on pullbacks, or you buy it on days where bond yields bounce, where everyone and their brother wants to still reiterate their view that rates are rising when indeed they're crashing at this point, which is interesting. And those are your top three things.